Have you ever wondered how the world's most successful investors make their fortunes? Well, a major secret to their success comes from a book that's been considered the holy grail of investing for over 70 years. The Intelligent Investor by Benjamin Graham. A book so profound that it even inspired the great Warren Buffett, who described it as the best book on investing ever written. We have gathered the 5 most crucial takeaways from this monumental piece, principles that will shape you as the investor you want to be. Key point 1. Mr. Market. So, who or what is Mr. Market? No, he's not your next-door neighbor. He's a hypothetical investor that Graham introduces to help us understand the stock market's behavior. Picture Mr. Market as an eccentric business partner who shows up at your door every day with a new proposal. One day he's an optimist. The next, he's a pessimist. His mood swings dictate the prices he's willing to buy or sell at, which can be influenced by a range of factors, from economic indicators to global events, or even the weather. Now, just because Mr. Market swings between irrational excitement and excessive negativity, doesn't mean you have to. As an intelligent investor, it's your job to stay level-headed and make decisions based on the real value of your investments, not on Mr. Market's ever-changing moods. If Mr. Market offers a price that's below what you believe the stock is worth, and you have the capacity to buy, you could consider buying. If he offers a price way above your valuation, and you're in a position to sell, maybe it's time to sell. But if his prices don't make sense to you, it's completely okay to ignore him. The key takeaway here is not to let Mr. Market's mood swings influence your decisions. Instead, you should use his irrationality to your advantage. When he's pessimistic, he might offer you bargains. When he's overly optimistic, he might buy your stocks at inflated prices. That's the beauty of the Mr. Market metaphor. It teaches us to be patient, rational, and opportunistic. It reminds us that the market can be irrational in the short term, and as long-term investors, we can take advantage of that irrationality. Key point 2. Margin of safety. The margin of safety is like a protective barrier. It's your insurance against the unpredictable world of the stock market. But how does it work? Imagine a stock trading in the market at $50 per share. But based on your analysis, you determine its intrinsic value, which is what you believe the company is actually worth, to be $70 per share. The difference between the price you pay and the price you believe it should be is your margin of safety. So, in this case, your margin of safety is $20 per share, or 40% if you prefer percentages. The great thing about investing with a margin of safety is that it provides a guard against errors in your calculation and against unforeseen market downturns. If you're wrong in your analysis and the actual intrinsic value is lower than you thought, or if the market takes a sudden dip, you have a safety net there to protect you. So, why is this concept so important? Well, nobody can predict the future. The stock market can be influenced by numerous factors, many of which are beyond our control. The margin of safety concept acknowledges this uncertainty and factors it into the investment strategy. However, it's crucial to remember that while the margin of safety can limit downside risk, it doesn't eliminate it completely. Remember, all investing involves risk, and it's our job as intelligent investors to manage it. Benjamin Graham suggests that the larger the margin of safety, the better. But of course, finding stocks that offer a substantial margin of safety can be a challenge. That's where thorough research and analysis come in, which Graham encourages throughout his whole book. So, that's the margin of safety in a nutshell. It's a simple yet powerful concept that forms the bedrock of value investing. Key point 3. Value investing versus speculation. Now, you may be thinking, investing, speculation, aren't they the same thing? Well, according to Graham, they are not. In fact, understanding the difference between these two can play a crucial role in how successful you are in the world of finance. Investing, Graham tells us, is an analytical process. It's about scrutinizing a company's fundamentals, earnings, dividends, assets, and growth potential is all factors that should be analyzed and considered. It's about gaining a deep understanding of what you're putting your money into and ensuring it is the right move. It's about making long-term decisions based on that knowledge and having a reasonable expectation of profit and limited risk. On the flip side, speculation is more about trying to profit from market fluctuations. It's about buying a stock not because you believe in the company's value, but because you think its price will go up. In other words, it's a bit like betting or gambling. And sure, some speculators do strike it rich. But it's important to remember that for every success story, there are many more tales of losses. Speculation is high risk and not for the faint-hearted. It often relies more on luck than sound financial judgment. So, which path should you choose? Graham firmly points us toward investing. He's not saying you should never speculate. But if you do, you should be aware that you're speculating, not investing. You should only speculate with money you can afford to lose, and it should not be the mainstay of your financial strategy. The lesson here? Be an investor first and foremost. Make informed decisions based on careful analysis, not on a hunch or hope. That's the path to long-term financial success. Key point 4. Defensive and enterprising investors. To understand this concept better, picture yourself at a party. On one side of the room, you have the defensive investors. They're cautious, preferring to stick to the tried and true. They're not into high-risk strategies and like keeping things simple. They seek to avoid serious errors and aim for an adequate return on their investments. On the other side of the room, you have the enterprising investors. They're the ones who are willing to put in the extra time and effort to actively manage their portfolios. They're always on the hunt for undervalued securities or assets that they can buy cheap and over time, sell at a profit. Let's dive deeper into these two categories. Defensive investors prioritize safety and stability. They like blue-chip stocks, index funds, and high-grade bonds. The kind of investments that can stand the test of time. They aren't looking for a quick buck. Instead, they're in it for the long haul, preferring steady growth over time. Now, let's look at the enterprising investor. This individual is more aggressive and hands-on. They're willing to devote more time to their portfolio, constantly researching, analyzing, and staying current with their investments. They are comfortable taking calculated risks for the potential of greater returns. Remember, neither approach is necessarily better than the other. The best approach depends on your personal circumstances, your financial goals, your knowledge and expertise, and how much time you're willing to dedicate to your investments. Graham's point is that you must understand which type of investor you are, so you can adopt the appropriate strategy. But no matter which category you fall into, Graham insists that one principle remains the same. Always aim for a margin of safety in your investments. Key point 5. Diversification. Now for the last, but still a very important part of intelligent investing, diversification. It's the classic strategy of not putting all your eggs in one basket. Spreading your investments around is an extremely important factor for a strong portfolio. Why is it important? Well, imagine you invest all your money in a single stock, and that stock crashes. You'd be in for a world of financial pain. If you instead have your money spread across a variety of different investments, the poor performance of one could be offset by the good performance of another. Graham strongly recommends diversification to manage risk. It's about balancing your portfolio so that you're not overly dependent on the success of a single investment. It's a crucial part of what Graham refers to as the margin of safety, which we've discussed previous. Remember, as an intelligent investor, your goal isn't just to maximize returns, but also to minimize risk. And diversification is a powerful tool in your risk management toolbox. And that, my friends, brings us to the end of our journey through Benjamin Graham's key principles from the intelligent investor. Remember, the intelligent investor is a realist who sells to optimists and buys from pessimists. I would strongly suggest you read the book for yourself, as it has a lot more to offer than we can present in one video. If you, however, found this video helpful and interesting, make sure to hit the like button. If you would like to check out more of our content, you can enter our channel and subscribe for upcoming videos on personal finance and growth. If you have any feedback or questions, we are glad to answer it in the comments section. For now, goodbye.